This is primarily about cost efficiency and accessing real estate as an asset class. And REITs are really a credible way to do it. And so it's something that should be considered one of the tools in the toolkit for an institutional investor. I think that for smaller investors, it's a pretty compelling choice.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guests today are Maaike van Bragt, Senior Research Associate, and Chris Flynn, Head of Product Development at CEM Benchmarking. Maaike and Chris are here to discuss some of the findings from the 2024 CEM Benchmarking study into investment performance across asset classes. Welcome to you both.
Thank you. Thank you for having us.
Let's start by describing, if you could, the methodology you used to create the 2024 CEM benchmarking study and what it was that you set out to explore.
Thanks, Sarah. I'll start by answering that, noting that a lot of what we did in the study is probably not overly complicated from a methodology standpoint. It's taking advantage of a proprietary database that we have. So I'll just sort of describe that to you, and then I'm going to hand off to Maaike for a little bit where it gets more complex. CEM, if you're not aware of us, we're a data and insights firm. We're based in Toronto. We work with several hundred asset owners globally, including about half of the world's 300 largest funds, and they are reporting data to us on an annual basis. The data being reported to us covers about $14 trillion in assets. And within that, the largest group of clients we deal with is in the United States. They represent about $4 trillion of that $14 trillion. We've got data in the US going back over 30 years, where these are asset owners reporting to us their allocations, their net returns by asset class, and in fact, by implementation style, which we'll get into a bit later. They're telling us performance net of costs. And from their perspective, it's net of all costs, which is quite unusual. So it's not just net of management fees, but it's net of the consulting costs or the internal teams needed to run a more complicated program. And they work with us to get sort of value for money benchmarking across the large asset owner community. That database, though, creates sort of the opportunity to look at some really interesting questions. You can look, obviously, at trends in asset allocation. You can understand what the true net performance achieved by investors looks like, which is a lot of what we've been reporting in this study. There's some advantages like the fact we have pretty low survivorship bias because we're not getting data from an investment manager who might disappear. We're typically getting it from a pension fund or an endowment who may have stronger, weaker managers within their portfolio, but they keep reporting data to us. So that's the data set we have. The study is really looking at what that performance has looked like in the United States. It goes back to 1998. The reason we're picking that as a start year is that we effectively started capturing data on some new asset classes that are interesting. And so we're looking really at what the true net performance by asset class for large owners in the US has been since 98. The only place it gets complicated, I'm going to hand off to Maaike to discuss.
I think the 1998 point is also really interesting because it gives us a very nice 25-year-old window, which is a nice number. So yeah, as Chris mentioned, we have a lot of types of data in the database. Most of it is used as it is in the database. We only might make one adjustment, and that is the delagging the returns for private equity and real estate for private real estate. I think it's well known that returns of private assets are lagged. There's a reporting lag. And so what we did is for each of the pension funds in the database that has more than 5 years of data, delagged their returns for both private equity and real estate. And so that's about 200 funds we did that for. And so when we do that, we see, I think as expected, a 3-month lag on average. Within the private equity funds, for private assets, that lag is slightly longer. We see, in fact, 2 peaks. The first biggest peak, we see a lag of about 8 to 10 months. And the second peak comes a bit later at 14 months. So the 3 months, I think, for PE we observe is, I think, a typical lag one would see for the GP to get their valuations done, to get them validated, audited if need be, and sent off to their LPs. In real estate, we will have that same lag as well. But in addition, I think we have appraisal smoothing that adds on top of that lag. The second peak is something we do not completely understand. Yeah, I think it would need some more research. But what we do observe is that those pension funds that are able to manage real estate in-house have, in general, shorter lags than those that rely external managers. Yeah, I think so. That's the only manipulation or change we made.
And what that lets us do then is look at a certain period of time and a certain market condition and more reasonably compare the performance of funds by effectively reflecting the market movement in the same time period. It also explains why in 2024 we're releasing a report that goes to the end of 2022. It's because behind the scenes we're waiting for 2023 data in the private market space to see what was actually probably happening in 2022, but wasn't reflected until their 2023 performance.
Great, thanks for that. What were some of the key performance trends across asset classes that emerged in the research?
I think, not surprisingly, when you have a study with a long-term history of data, it does appropriately taking a long-term perspective on performance. Looking over net returns over a time period across 12 asset classes where we're looking, private equity was the strongest performer over the 25-year time period, as I think it would hope to be. It's a relatively higher risk, higher return asset class by design, and that is what it has delivered over 25 years. Average return in a typical year is about 12%. That's net of everything to the investor. The next strongest asset classes were REITs and US small cap. They both performed strongly as well. Average returns about 9.7% for both of them over the past 25 years. And to a milder extent than private equity, but similarly, both small cap and REITs have had their ups and downs in individual years, but over long periods of time, those have both been very strong performers. The lowest performers on a long-term basis are bonds, around 5%. It depends on the category of bonds we're looking at, but where you would a little bit, I think, expect them to be in the long term. Lower risk, lower return asset classes. Private real estate, which is obviously something we're going to be talking about a bit today because of its correlations with a mid-performing asset class, 7.7 on average over the 25-year period. If you look into the paper, you can see it on one-year basis and multi-year rolling basis for that whole time period, but really stepping back over 25 years, that's the kind of risk-return trade-offs we're seeing. There's also a trend we're seeing in asset allocation. There has been a long-term trend towards larger private market investing. If you compare to 1998, the average allocation to large cap stocks was 42%. By 2022, that number dropped from 42% to 12%. So a real shift out of just core large cap equities. Meanwhile, private real estate doubled. Private equity went up by a factor of 4. These are averages, so there's a variety. There's some funds in the database that are 100% public. There are other funds that are 60 or even 80% private markets, but that average trend has been pretty significant. The last observation that I'd make that's sort of topical for this year, something that popped out, is Maaike spoke earlier about how there's been a historical lag between reported returns by investors in private real estate versus what we see in public markets. And that lag has typically been something like a year. And that was true for most of the 25-year time period. It was not true when COVID hit. When COVID hit, we saw not maybe complete revaluation of real estate, but a much faster real estate revaluation than we have typically seen. COVID hit, and maybe rather than waiting 6 to 9 months to see if buildings were selling at a lower price, people were taking some markdown right away. What we've seen in the last couple of years as we've exited COVID is a return to the traditional valuation lag. So COVID didn't cause a permanent change in valuation speed. It was an unusual event that triggered a faster revaluation. We're back to private real estate lagging public real estate by more like a year.
How did REIT performance compare to private real estate and its various ownership structures over that same time period?
Within real estate, that you can implement it in different ways, right? Some of the large pension funds can hire people internal, set up their in-house real estate team. Others rely on GPs, external managers, or sometimes they might even use fund of funds. In addition to these sort of private assets, you can of course also use REITs, which are real estate as well, just public. What is interesting actually is if you look at the correlation between private real estate and REITs, the correlation is quite high once we neglect those net returns for the private assets. I think we mentioned that REITs performed really well in the past 25 years. And so when we compare that to styles used within the private asset classes, we see that they are still a top performer, equal performance to those that have an internal team and can deal with their real estate portfolio in-house. So they both form returns that we see on average from GPs or external, and for sure perform fund funds.
And what about REIT correlations to other investment options? How did that present in your research?
It's a great question, and an interesting one. Maaike mentioned how listed REITs and private real estate, once you adjust for timing differences in when they report performance, the correlation is really high. And by high, we're talking, I think, a 0.9, 90% correlated, which if you're not used to looking at correlation tables means they're moving together, not exactly, but about as well as, say, European stocks move with US stocks. So there's a difference, but there's pretty significant movement between these things together. When you point this out, that they're really similar once you adjust for that, sometimes there's a tendency for people to think, oh no, because if you didn't adjust real estate, you'd have a overly positive view of how decorrelated it was from markets. And so we said, actually, it's pretty correlated to REITs once you adjust for timing. Sometimes people that interpret that to mean then there's no diversification benefit anymore. They're actually underselling how much of a diversification benefit REITs or real estate, when you even after adjusting, are in a stock bond portfolio. Now, they're not as decorrelated as stocks and fixed income, but we see a correlation between REITs and equities of, say, 0.6. You could compare that to something like hedge funds has a 0.8. So hedge funds are significantly more correlated with equities than REITs are. And REITs are adding a real, if you were to start saying, what are the major asset class groups? You go, equities is my big one. And that's going to include public equities and private equities and emerging. And they're different. There's diversification within equities, but that's one big area. Bonds are my next big area. Real estate, whether public or private, so whether it's via REITs or whether private real estate, is probably your third next major diversifier that's giving you a more attractive, diversified, long-term risk return option.
Great. And can you also talk about the additional research that you did in terms of the impact of active management on REIT portfolios?
Yeah, we did that additional paper that we released last year. I'm going to let Maaike get into the details of it in a second, but the question we were trying to answer is effectively what happens if you give some active risk potential or willingness to make active decisions to REIT managers. Our sense, talking to investors in the industry, is that they may, some people are comparing private real estate to REITs, but I think a lot of them are comparing what they think they can get in private real estate to a REIT index, or effectively what they'd get as a passive investor in REITs. And many of them believe that they have good connections in the market. They may even believe that they could be a top quartile investor and have above average performance in private real estate. We had noticed long ago that actually the average active REIT investor in our database, so that is funds who are trying to select which REITs to invest in, was outperforming the index. And so a little bit we were trying to look at, so what happens if you compare actively managed REITs to private real estate, which is always actively managed, and how does that look? And Maaike, do you want to speak to that?
So what we did in that study is look at the returns of like top, median, and bottom performers in both REITs and performance REITs. And what we saw is that in all groups, the REITs managers outperformed the private asset managers. And so what I mean to say is that like the top REIT performers, the top private asset performers, but also the worst performing REIT performers still outperformed the worst performing private real estate managers. And so I think it's really food for thought to think about that, because in reality, not everybody can select the top private asset real estate manager.
Putting everything together that you've talked about so far, how should institutional investors, what should they take away from your research regarding how they should consider using REITs?
I think the paper really shows that on a net return basis, REITs have done really well in the past 25 years. And so if you have real estate in your asset allocation, I think you should seriously consider using REITs, or at least adding them to it. We also saw in the paper, I think, that REIT is a great diversifier. So even if you don't have a dedicated REIT portfolio, you still might want to consider adding REITs or your public equity portfolio. But I think whether or not you want to use REITs is really a decision everyone should make based on their opportunities. But yeah, keep in mind that if you are not able to really internalize or so bring people in-house to set up a private real estate team, REITs might be a very good alternative to that.
Yeah, I would highlight what Mike said there, that really when we looked at the performance in private real estate by implementation approach, where people directly buying buildings are getting similar net returns to REITs, while as you move into funds, the performance is lagging, and you move into fund of funds, it's lagging even more. So this is primarily about cost efficiency in accessing real estate as an asset class. And REITs are really a credible way to do it. And so it's something that should be considered one of the tools in the toolkit for an institutional investor. I think that for smaller investors, it's a pretty compelling choice. You'd have to really be with above average private real estate managers or have a sort of more interesting, unique, less traditional fee structure to probably prefer it over REITs. But as you get larger and you're able to directly invest in the real estate market, you now say, okay, I have two tools in my toolkit. I can buy buildings or I could buy REITs, and I could use funds as well. I think in our database, it looks like REITs are probably underutilized as a complement to a large direct real estate portfolio. We've seen a few funds globally do that, but you might say, hey, I have a direct portfolio of malls and office buildings that I'm happy with, but that's the limit of my real estate portfolio. Or I'm only in certain cities where I can be a direct investor. Complementing that with REITs could be a way to get portfolio coverage in a cost-effective way. REITs can also work with real estate to give you a bit of a liquidity buffer that allows you to rebalance. It's when you start seeing that REITs and real estate are similar once you adjust for timing, it's a way to have more control of your total portfolio asset allocation and to more rapidly enter the asset class, or to have a place to keep your powder while you're waiting to deploy it in private markets.
Maaike, Chris, thank you so much for taking the time to explain your research with us today.
Thank you for having us.
Thank you for having us.
To our listeners, if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.